An example of the efficiency ratio is the inventory turnover ratio. The inventory turnover formula is the cost of goods sold divided by inventory. We use the cost of goods sold with inventory because both of them are costs. We get the cost of goods sold from the income statement and we get the inventory from the balance sheet. Please note that the income statement is a flow account, which means it is calculated over a year, while the balance sheet is a stock account, which is calculated on a certain day. Since we cannot compare a year to a day, we need to convert a day into a year by getting the average of the two balance sheet items. So, we will use one income statement and two balance sheet items. In summary, anytime you find a financial ratio that includes an item from the income statement and an item from the balance sheet, you will use the income item and get the average of the two balance sheet items. So, we can rewrite the inventory turnover as cost of goods sold divided by the average inventory. Let's calculate the inventory turnover for the year 2018. Cost of goods sold is equal to $30 million divided by, let's look at the balance sheet for inventory. Please note, 2018 is the first year of operations. Consequently, we do not have the average inventory as we do not have the previous year. We have inventory in the year 2018 of $20 million. So, in our formula, we will divide by the inventory of $20 million, which is equal to 1.5 times. The unit of the inventory turnover ratio is times. It means that the inventory is sold on average 1.5 times a year. The higher the inventory turnover, the better. Next, let's calculate the inventory turnover for the year 2019. Costs of goods sold in 2019 are equal to $38 million. Divided by, well, let's look at the balance sheet for the average inventory in the years 2019 and 2018. We have inventory of $28 million in 2019 and an inventory of $20 million in 2018. So, in our formula, we will divide by the average inventory of, open bracket, 28 million plus 20 million, close bracket, divided by 2, which is equal to 1.58 times. The unit of the inventory turnover is times. This means that the inventory is sold, on average, 1.58 times a year. The higher the inventory turnover, the better.